Financial markets have seen big volatility of late, certainly centered around the idea of stagflation in the US, a rise in terms of tariffs on global trade, and the potential for Europe to ramp up spending as the US essentially withdraws the military assistance for Ukraine. There's a lot going on at the moment, and there's plenty more to come with the coming weeks, seeing CPI out of the US, so that stagflation issue coming back into play once again. We see GDP out of the UK, and we see the central bank decision from the Bank of Canada. So here are the big ticket items according to Trading Economics, kicking off on Monday with the balance of trade data out of Germany, the Westpac consumer confidence change figure from Australia. And then on Tuesday, that Australian theme continues with the business confidence survey, followed by the JOLTS job openings number. That comes off the back of a week that's been dominated by jobs talk. So certainly if we see a significant amount of job openings, that's one thing, but you've got question marks, of course, around the people essentially losing their jobs within the government under the Doge initiative. Wednesday is probably going to be the big ticket item, really, or a big ticket day where we see the inflation data coming out of the US in terms of the CPI numbers. And then we've got the Bank of Canada interest rate decision on the same day. Inflation continues on Thursday with US PPI, and then on Friday we've got consumer sentiment out of Michigan, but we've also got a raft of data points coming out of the UK. Now, let's kick off with the US. I'm recording this prior to the non-farm payrolls release on Friday, but we have started to see some signs of weakness within the US jobs market. The ADP number came in about half of what was expected. The Challenger survey saw a big job openings, or a jump in job openings in relation to, or quits, sorry, in relation to the government. And that's certainly something that we're going to be looking out for when it comes to the JOLTS job openings, right? The big question mark here is whether the Doge initiative essentially is pushing the US towards higher unemployment, lower income when it comes to taxation, higher benefits. Those are the kind of implications that come when you force a lot of people out of their jobs and close down entire departments. But really, the week's going to be focused around that CPI number. Now, there's been big concerns of late around what's going to happen when you see the imposition of tariffs, so higher prices, 25% potentially on some of the key goods coming into the region. And you see question marks about the direction of travel for the economy. Certainly, many businesses with the concerns around tariffs have, by and large, likely eased off in terms of their activity as they're waiting for greater clarity over the issue. And that's likely to point towards a weaker growth outlook going forward. So inflation is going to be a key one here because we've seen inflation rearing its head even prior to the tariffs. So there's an expectation of higher inflation, and sometimes that's all it needs to send prices higher. Of course, CPI is only half the story. We've got the PCE figure, and the core PCE metric, by and large, has been a lot more controlled than the CPI numbers. And you can see it here, right? The middle section is where we're looking at the moment. And essentially, we want to be at or below that horizontal line that's just below 0.2, which is 0.16 recurring. That's what we need to get to and remain or rotate around to get back to 2%, the target. We haven't been there for some time now, and certainly we've been seeing significant upside coming into play when it comes to the CPI and the core CPI metrics. Key to that is the idea that we're essentially seeing a ramping up in terms of inflation within both the core and the headline, which means that you've got no excuse, really. You know, sometimes we might see headline inflation moving sharply high, and we don't necessarily see that for the core. And then central banks can say, you know, maybe it's down to energy and like, but you know, it's not something that's happening on this occasion. If we look in terms of the breakdown for different elements of US inflation, whether it's core CPI, just shelter, which is a huge component of inflation of CPI, the core excluding shelter, services sector excluding shelter, the core PCE metric, and then the headline CPI number. Well, the only one that appears to be relatively under control is the core PCE metric. All of the others are moving towards the upside on this 6-month annualized change. So this is talking about the past 6 months, you know, the direction of travel essentially. And so inflation certainly appears to be rearing its head once again. What we've seen recently isn't necessarily a reflection of those inflation concerns. Instead, it's a reflection of the concerns around growth in the US. Part of that is also because of the fact that, if you implement significant tariffs against the likes of Canada and Mexico and China, and they reciprocate, well, you're making yourself poorer, quite frankly. And so all of a sudden, the economic outlook starts to sour, and people start to think that the central bank needs to step in. And so, not so long ago, we were talking about the possibility of no rate cuts this year. Well, that's off the cards. We were talking about the base case scenario of one rate cut, which is 400 to 425. Well, that's pretty much eradicated now. We're talking about a 10% allocation to that in terms of market pricing on the CME. Instead, we're now pricing 3 as the base case scenario, which is down to 350 to 375. So what we are seeing as an outcome of the current concerns is an expectation of greater easing. And to some extent, that sort of helps things along in terms of some markets, but not for others. Now, it's notable that if we're looking at the Dow Jones Industrial Average, what we've been seeing here is not necessarily reflecting that change in terms of expectations from the Federal Reserve. Instead, there's concerns around how businesses are going to struggle their way through a potential trade war that could be long-lasting, and that the benefits of Donald Trump being in power might take some time to come into fruition. There's talk of it potentially being Donald Trump economy within 6 to 12 months. And so, do we want to suffer for 6 to 12 months? No. And so people are reacting, and we've got the possibility of a double top formation here, certainly with this support level at 41844 coming into play. Does that mean that it's going to happen? Not necessarily. Let's just look at this wider time frame. You can see the weekly time, but very clearly in a bullish trend. If we're looking at sort of signals that we could roll over, what are the kind of tools we might want to utilize? One could be the Bollinger Band, but on this occasion, I think it's good to look at the moving averages. So the moving average ribbon is a good one. So by and large, if you're looking at the moving average ribbon, generally you'll be looking out for where it sort of worked in the past. I would say arguably it's not been great, quite frankly. A lot of the time I'll say this is one I've not sort of prepared, and you can see it there. So this is the monthly time frame. Is it working better here? Sometimes we've seen it respecting that sort of upper 20 SMA on the monthly. We're still some way away from that. Let's look at it on the daily time frame. So the daily time frame, it's relatively choppy a lot of the time on those first 3, and sometimes we're coming back into the sort of 200 as support and resistance. So sometimes it's a case of trying different time frames, trying different moving averages, and that's why the ribbon's particularly good, because it shows you some of the key moving averages and highlights that. So what you can see here is that the 200-day SMA currently lies on that neckline of the double top formation. So again, that sort of strengthens that position as a key support level. Are we going to reach that? Well, at the moment, it looks likely, because we're continuing to decline. At the moment, we've seen this consolidation retracement phase and now declining. So if we break through 42347, it starts to look like we're going to head lower once again. This comes off the back of a retracement in around just up, sort of front on that 50% retracement. But certainly, as things stand, the near-term trend is a bearish one. And this looks something akin to this. So if we were to break down through support, then it starts looking like we could break into this neckline potentially and challenge it. Maybe we base out at that level, maybe not. But certainly, given that that's tying up with that 200-day SMA, it's the kind of area we could see a signal to markets that we're going to be heading for deeper declines if we break through that key level. So the Dow's going to be a really interesting one to watch for the week ahead. Next up, let's look at the UK area. Oh, no, we're looking at Canada. So Bank of Canada interest rate decision. To be fair, that is the second most important decision of the week. We've got the Bank of Canada expected to cut by 25 basis points. I have filled out the screen definitely here, because the rest of this, by and large, doesn't really make that much of a difference. It's all about that BOC decision on Wednesday. Markets expecting the 25 basis points cut. This is why markets at the moment are reacting quite heavily to differences in terms of expectations around the potential for tariffs or not implemented on Mexico, because essentially it highlights how the US exports around the world, and therefore its percentage of GDP that is attributed to just Mexico or just Canada is relatively low. Whereas the likes of Mexico and Canada highly reliant on their neighbor. You can see that Canada, it was higher back in 2000, but it remains roughly around that 20% mark. 20% of GDP comes down to exporting into the US. And so whilst Canada are, the Canadians are saying, or Trudeau saying, don't go on holidays to US, don't buy US goods and things like that. Ultimately, the implementation of tariffs in both directions will be particularly difficult for the Canadian economy compared to the US. And, it's for different reasons, but ultimately, you're looking at in a position where the US economy is so big and they have so much domestic consumption that they're much better positioned to withstand significant economic shocks than the countries around it. In terms of inflation in Canada, you can see here that we've seen a fair bit of choppiness over the course of the past 6 months or so. By and large, we're waiting for the February reading. So you've got another 4 months of significant disinflation potentially ahead. If you look at the monthly figures from last year, it points towards a possibility of substantial downside to come. And we're already at 1.9. So, we're talking about dropping down to 1%, even 0% if we see particularly low numbers like we've seen over the last 3 months. Right, so inflation certainly isn't holding back the BOC. You can see that the 6-month annualized is at minus 1% at the moment. So the Bank of Canada is certainly emboldened to be able to take actions once again. Do they need to? Well, certainly it probably makes sense to get ahead of what's happening in terms of the US and Canada. 1 minute they're implementing 25% tariffs. Next minute they're holding off on autos. Next minute there's talk of potentially holding off on all of them. We're likely to see significant volatility coming into play. In terms of the market I wanted to bring to your attention, it's the Canadian dollar against the Swiss franc. Now, ultimately, this is the case of having looked at the sort of wide breadth of charts that are out there. This one looks particularly interesting at the moment because you've got a very clearly established bearish trend here. You've got the Canadian dollar really coming under pressure given all the fears around losing so much trade and their main trading partner essentially not becoming much of a partner anymore and instead being almost an adversary, really, when you're talking about booing national anthems and stopping going on holiday there. So what we're looking in terms of the recent move, you can see here right up into that 76.4 fib, rolling over, coming down through support after this consolidation that's lasted, well, much of the last, say, 9 months or so. And so, yes, you have got this key support level just below down here, around about 6060. But nonetheless, we've broken support, we've retraced into 76.4, and now we're looking like a potential bearish engulfing candle. So it still looks relatively bearish. But, of course, what the Bank of Canada do or don't do is going to be key. And certainly when we look at the prospect for easing, you can see here that 64% chance of a cut, but people aren't really questioning whether we see a cut or a 25 or a 50. People are questioning whether it's going to be a cut or not. And then beyond that, you're looking at maybe 1 or 2 more cuts for the rest of the year. So there still could be plenty in the tank. And there's going to be a big theme around, where is that neutral rate for the Bank of Canada? But for the time being, we certainly do have a lot of fear around the economy in Canada, and the Canadian dollar is reflecting that. So there's going to be a toss-up between what's more important. But arguably, the Bank of Canada rate decision is a one-off event, whereas the talk around trade between Canada and the US is something that's just going to be rumbling on over the course of the week. So we're likely to see volatility potentially coming from that area as much as the Bank of Canada interest rate decision. And then finally, let's look at the UK. Like I said, we've got the GDP number coming out on Friday. That is part of a whole raft of data points coming out: industrial production, manufacturing production, and alike. We've also got the year-on-year GDP metric coming out. There's an expectation that's going to drop down to 1.2 from 1.5. So if we're looking at the potential implications for this, we've got to look at how these economic data points might impact treasury yields. Now, you can see here I've got UK versus US 10-year yields as a ratio. That's the orange line. And then you've got cable, which is the blue line. And as you can see at the moment, these lines are lining up very well. So we're seeing higher yields in the UK, and in Europe as a whole, you're seeing lower yields in the US. And that is providing upside for cable, for Eurodollar and alike. Part of it is the fact that the US at the moment is essentially trying to drive down their borrowing, and that essentially eases yields at a time where Europe is having to ramp up defense spending. So that provides a backbone to this move higher in terms of yields. And then if you look at these data points and think, how could they impact on treasury yields? Well, yields are also a reflection of expectations for monetary policy, and in particular the 2-year, but certainly also reflected in the 10-year. And so if we were to see particularly strong GDP numbers, then maybe you'd factor in less rate cuts and you'd be pointed towards a higher yield. If we see particular weakness, then there's a possibility that we see it pulling back a little bit. So the possibility of it being a positive relationship between GDP or the data that's coming out, because we also see, say, industrial production, manufacturing production alike. If you see strong numbers, good chances we see strength in terms of cable. Weak numbers, potential weakness in terms of cable. But like I said, we've got the backbone that is the possibility of ever higher borrowing costs in Europe, and that drives yields up because people become fearful. And if you're to borrow from someone, if someone's already got a huge amount of debt, you want a good rate of return. If they don't really have much debt and they're very secure financially, you're like, okay, fair enough, I'll have a lower rate of return. So higher borrowing in Europe and the UK for defense spending, and the US trying to drive it down, trying to do everything they can to drive it down, all of that really provides the basis for further upside in terms of Eurodollar in my mind. Now, let's look finally, before we look at the chart, at the Bank of England expectations. Markets pricing in the first rate cut from here onwards in May time. Sort of 68% chance of that. And then do we see one by year end? Yeah, most likely see another one. So possibility of 2 rate cuts for the remainder of the year from the Bank of England. But like I said, these markets aren't only being driven by that at the moment. So this is cable. Let's look in terms of, just get rid of these. Let's look in terms of the wider context, the monthly time frame. So we've seen this pullback coming into year end, and then since Trump's come into power, we've just seen an initial pop for the dollar, and now it's really coming under pressure. The near-term trend, very clearly a bullish one, and I think that's going to continue, quite frankly. If you look at the hourly time frame, you can see we're seeing a bit of consolidation here at the moment, and so you could have some question marks about the possibility of us sort of starting to enter a bit of a consolidation phase. But look out for the swing lows. I mean, ultimately, the near-term swing low of 128 provides the backstop to that. If we break through that, then it looks like a wider retracement, but I think it's a good chance that we do see continued weakness in terms of the US dollar, and therefore short-term pullbacks are potential opportunities for bulls. And ultimately, you need to see something to tell you that the trend is over, and that would mean a breakthrough 128 to point towards that wider retracement coming into play. Like I said, GDP and a number of these data points will be important, but as important as that, it talks around the trade relationships between the US and global partners, and also now the kind of borrowing that the US will be doing with the cutbacks under Doge compared to some of the other countries around the world, most notably in Europe. Hope that's been useful. Have a great day, great weekend. Have a great week ahead. Like I said, it's a very volatile time. Anyone that remembers Donald Trump's initial stint in power will remember exactly that. And he's kicked off in very similar fashion, quite frankly. Anyway, my name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day.